it's a pleasure to be with all of you. I think we've got a very smart audience at LSE, so I'm looking forward to the session. And thank you for having me.
Absolutely, Mohnish. It's an incredible pleasure to have you. Hopefully our introduction wasn't too long-winded. But to all of you who joined, just a quick rundown of the event. We're going to ask the hardest questions we could find, as Mohnish asked us to. So hopefully those yield some excellent answers, which I'm sure they will. And then 40 minutes in, we'll open it up for questions from the rest of the audience as well. So Mohnish, our first question. So of course, you used to be more of a, let's say, deep value kind of guy, and then you evolved and became more of a Moats kind of guy. And then this is, of course, very, very broad. But we'd like to focus on the Moats part and ask, of course, not all moats are made equal, right? So what's the best source of sustainable competitive advantage for a company, i.e. what is the best moat that an investor can find in your experience?
Yeah, well, just a little bit of a correction. When I actually started my journey as an investor, which is now about 28 years ago, I was actually a buyer of great growing businesses, because you always do the best if you can buy into a business that's going to grow intrinsic value significantly over time. Usually that's better than buying discounted dollar bills and such. But then as we got to 99, 2000, and this great dot-com bubble was brewing, I was probably able to see it not very much in advance, but probably 2 or 3 months ahead of where everybody else was, or most people were. And thankfully, I was able to sidestep the bubble. Things went really well from 95 to 2000. I think I had $1 million, and it was up to about 13 million in that period. And then Pabrai Fund started in 99. And at that point, I actually switched, 99, 2000, I switched to Graham Deep Value, because the interesting thing was on March 9th, 2000, which is the day the NASDAQ peaked at about 5,000, was the day that Berkshire Hathaway actually hit a multi-year low. So there were lots of undervalued assets in non-sexy businesses. And there was a lot of froth and euphoria in the whole tech and dot-com space. And of course, the NASDAQ over the next 3 years went down from 5,000 to about, I think, 1,200 or so, like a 75% decline. And I was buying funeral homes and steel companies and so on, and those did extremely well over that period. So in general, to answer your question, capitalism is brutal. In businesses are aberrations. So the nature of capitalism is such that if someone builds a better mousetrap, which, grows a company and generates high returns on equity and very profitable and so on, they have a target on their back. And in general, that will attract a lot more competitors to enter your space. And they'll try to chip away at whatever advantage is there. And mostly they will succeed. And moats are really more the exception to the rule. Let's say you have some small city in England and it has no Thai restaurant, for example. And someone looks at it and say, yeah, I think your Thai restaurant do really well here. And they open a Thai restaurant and they do really well, and they're full all the time, and they can charge premiums versus London and other cities. That is going to attract more people and more entrepreneurs to open Thai restaurants, until eventually the economics of the Thai restaurants in that small city may be no different from other parts of England. Now, sometimes what happens in capitalism is we get aberrations. And when this pharmacist started the Coca-Cola company, he had no idea what he was on to. And no one could have imagined that Coke would end up being the brand it is today. And actually, quite frankly, there's nothing particularly magical about Coke, in the sense that they say they have the formula locked up in some bank vault in Atlanta. But it's really easy to clone Coke, and several companies have done that. And when Pepsi introduced the Pepsi Challenge in the 1980s, they basically gave people 2 colas to drink with no brands on them. And they said, tell us which one is better. And most people preferred Pepsi because it was a little sweeter. And then after they took the test, they would tell them, oh, by the way, you preferred Pepsi. But if they presented the two drinks to most people with the brands, Coke and Pepsi, most people would prefer to take Coke. And so Coke's moat is, if you look at it kind of objectively, it really doesn't make any sense. They have a product that can be very easily cloned. They have competitors in many cases who have better products, but a brand got built. And a brand got built and people have preferences, and they don't have a full lock-on monopoly in the sense that when you go to the supermarket, if Pepsi is 20% cheaper, a lot of people will switch. So the brand loyalty is not that extreme in something like Coke. The same applies to Visa or MasterCard, American Express. If you just look at the different businesses that we see as having great moats, we can tell in hindsight that a business has a great moat. Now, even a business that has a great moat, the nature of capitalism is that moat is very likely eventually to get filled in. So if we go back in history and we look at businesses that have survived and thrived for a long time, very few businesses that are founded make it past their first year. A few will make it past their fifth year, and even fewer will make it past their 10th year, 20th year, 30th year. It just keeps going down. If we start looking at businesses that are more than 100 years old, for example, that we would recognize, like the Coca-Cola company, American Express, and so on, Wells Fargo Bank, and so on, it's a very small number. And if we go to, let's say, 200 years old, might get some liquor companies, few things here and there. The oldest business, the known oldest business on the planet, is a very small boutique hotel in Japan, 30 odd rooms, that has been running for about 700 years in the same family. I think it's like in the 35th generation or something. And they've survived world wars and they've survived all kinds of things. Japan's gone through a lot of change in 700 years. But basically, if you start looking at businesses that are 200 years old, 300 years old, 500 years old, you're not going to find very many. And we're not going to find very many that are even 50 years old. So if you look at a business today, let's say, for example, we'll take a look at a business like Apple today. Is Apple going to be with us in 10 years? I'd say that's a pretty good bet that, yeah, they'll be around in 10 years. Will they be around in 20 years? I think the odds are high that they'd be around in 20 years. But I don't know whether I could make a statement that the Apple of 20 years from now will be a more valuable company than the Apple of 2023. It very well may be, or it may not be. And then if we, let's say, ask the question 50 years from now or 100 years from now. So do we expect Apple to be a more valuable company 100 years from now? And if I were a betting man, which I'm known to be, I would take the other side of the argument and say that I don't think it's going to be more valuable. I was having a conversation with Charlie Munger a few weeks ago, and I told him, Charlie, the one thing that's going to survive in the Berkshire portfolio for more than 200 years is going to be the railroad. So Berkshire owns Burlington Northern Railway. Now, 200 years from now, the technology of rails may change. Maybe for freight, it might be maglev or something else. But the point is that they own the rights of way, and they own that land, and they own the connection to the ports and all of that. And humans need some way to transport goods in large land masses. So I think the Burlington Northern Railway is likely to be around and thriving 200 years from now. And then Charlie said to me, he says, I think our utilities will be there as well. They have a big business with a lot of power companies that Berkshire owns. And he's probably right about that. But he did not mention to me that Coke would be there, for example. And I think Coke will be there. I think that's a pretty decent shot. But they very well may not be. We don't know. 200 years is a long time. Look at the world 200 years back. So the difficulty with capitalism is that when we look at businesses that may look dominant today, our job as investors is to project what these businesses may look like 5, 10, 20 years from now. And that is a very difficult exercise because you have all these marauding intruders who want to take away your moat, who want to take away those profits, and they're continuously coming at you. That's what makes this a fun and exciting endeavor from my point of view, because trying to figure those things out is not that straightforward.
Mohnish, you talk a lot about the time there. And I think, particularly given that the market typically runs on 12-month cycles, do you think that investors as a whole structurally undervalue these quality, fantastic, compounding businesses as just a matter of course? Because how is it really possible to value a business that you know is going to be producing cash for the next 100 to 200 years? And do you think that therefore the opportunity for retail investors is A, obviously in the time, but B, also to spend almost all of your time looking at the quality of the business rather than anything else?
Yeah, so one of the arrows in our quiver as value investors is patience. So in general, we don't really have, for the most part, an information edge. So if I'm looking at a business, there's not much I'm going to be able to come up with about that business that a lot of other people haven't figured out or are capable of figuring out. So the information edge, for the most part, doesn't exist. Then there can be another edge, which is an analytics edge, which is two individuals have the same information, but one person is able to look at that data and come to conclusions that are different from the other person. And so an analytic edge can be a real edge. But even that is difficult because there's a lot of smart people looking at a lot of companies. The one edge that is probably the strongest is the time horizon. And even Jeff Bezos says that a lot of his competitors are focused on the next 1, 2, or 3 years. And he said that Amazon always took the approach of looking out longer, looking out 5 or 7 or 10 years. And he said that when they looked out longer and they invested with that longer time horizon, they got an edge. And they were willing to make investments where they knew that the payoff is not going to come in 3 years. So I think, yes, the ability of an investor to think longer term. And this is one of the reasons why the index does so well. The index is too dumb to know that it owns Microsoft. It's too dumb to know that it owns Alphabet. And it's too dumb to sell these things. And it keeps these things endlessly forever. So if you look at the S&P 500 index, for example, which is 500, for the most part, great businesses. And every year they might take 1 or 2 businesses out and replace them with 1 or 2 new ones. But usually the ones they take out are not the ones that are climbing. Like recently they removed General Electric from the Dow Industrial Average. And if you look at the Dow Jones Industrial Average over time, in general, you get rising stars going in and you get kind of companies that are kind of long in the tooth and have passed their prime being taken out. The S&P 500 would hold an Apple or a Microsoft or a Amazon or Alphabet for 20 years, 30 years. And that type of holding period on these great businesses can be a great edge.
And these edges, of course, in a lot of ways, so when we talk about moats, we're obviously talking about competitive advantages, which is an overused term in business for the room as well. A moat really is a sustainable competitive advantage that you can maintain over time, right? And of course, these are, and the old adage is that you need a business that can survive an idiot running it because one day an idiot will, right? And I think a lot about moats is that it provides that kind of downside protection. But when you talk about like 10 and 100 bankers particularly, like that requires at that level serious, competent, and impeccable management execution. And I think personally, at least, that finding good, competent management integrity is probably the single hardest thing because anyone can look at Coke and say, right, this is what makes the business better than Pepsi. But to really look at a person and say, this person, it has not only got a good track record, but has the ability to tackle like the issues of tomorrow in a way that no one else can, seems to me to be almost impossible. What do you normally, when you're looking for your 100 baggers or your 10 baggers, how do you go about that kind of that issue?
Yeah, there are two different frameworks that one can employ. So a simple way to get 100-bagger, one could get 100-bagger on a company that is never going to grow by buying it at 1% of liquidation value. Right. So if something is worth $1 billion and you were able to buy it for 10 million, and you were pretty confident that the billion value would not go down, you might have yourself 100-bagger. And I'm not trying to be facetious, but I just want to point out that Charlie Munger says that the greatest investing mistake of his life was a friendly broker called him in 1977, and offered him 300 shares of an obscure pink sheets company called Belridge Oil, which had a very large oil field in Bakersfield, California. And Charlie was familiar with this company. It was very thinly traded. There wasn't much disclosure, but he knew that at the price he was being offered those shares, at that time, I think the market cap of the company was something like $120 million or something. And the dividend yield was like 15%. It was very cheap. And Charlie said that without even doing much of an analysis, you knew that you were buying it for 1/5 or 1/10 or less of what the actual underlying assets were worth. And it was quite a remarkable field, and they owned the land. It wasn't a lease, and they owned everything underground. And so he bought the 300 shares at $115 a share that were offered. And then 2 days later, the broker called him back and offered him another 1,500 shares of Belridge Oil, again at the same price. This time, Charlie didn't have the cash handy, and he would have had to sell something to buy Belridge. And he should have sold, because whatever else he owned in his portfolio was not a 20-cent dollar or something. It was not that cheap. But it required him to sell something and then raise the money and then buy. And he called the broker back and declined. And he said that, so 2 years later, this 100 million market cap company was bought by Shell Oil for $3.5 billion. And it was like 30x or something, 120 million or something. So it was a 30x in 2 years. And at that time in 79, Berkshire Hathaway was trading at about $300 a share or something, which is now approaching $500,000 a share. So if you think about Charlie's 30-odd thousand he put in, it became $1 million in 2 years. And then it was another probably more than 1,000x, more 1,500 or 2,000x from there was a journey from Berkshire. So that million became something like $1.5 billion today. So the 30,000 in effect became $1.5 billion, 35,000. The 1,500 shares that he took a pass on would be worth something like $7.5 billion today, which I think exceeds his total net worth today. And this is the kind of like I would say, or what would I call it? I would say it's the cross connect, where you take the first company and you get a 30x. And then you take the second company, and in his case, he got a 1,500x. So you end up with 45,000x, some crazy number like that. And when well past 100x, we're not in Kansas anymore. And that was now the second company that he invested in, Berkshire Hathaway, was a great growing business. And that generated a lot of the returns because of the growth. Recently, in 2019, I found my Belridge Oil, which I thought would never happen to me, but I know God loves me. And so in 2019, I found this company in Turkey, which was basically trading at 3% of liquidation value, very similar to Belridge. And unlike Belridge, or maybe not quite unlike, because Belridge eventually, I think Shell pulled out something like 40-50 billion of oil from that oil field, and it's still flowing today. But this company in Turkey, not only was it a 3-cent dollar bill, it's growing its value. And in fact, in the last 3 years, it may have doubled its value. I was buying something with a market cap of 20 million that was probably worth at least 600 or 700 million. it's probably worth something like at least $1.5 billion today. And it's going to keep going. So I may not need to do a cross connect. All I may need to do, which is very difficult to do, is do nothing for a very long period of time. Like Rip Van Winkle, just go to sleep. So I could either go to sleep for 20 years, or I could spend 20 years talking to the wonderful students at LSE. So I hope you will invite me back, because I need something to do for 20 years, because I have literally got nothing to do now. I just have to twiddle my thumbs and make sure there's no sell orders placed. And so one way you can get the 100Xs is, and take a step back, there's 50,000 or so publicly traded companies around the planet. All their prices are set in a auction-driven format, like horse racing, the pari-mutuel system. So the way prices are set on the New York Stock Exchange, the way the odds are determined on the race course are identical. Basically, it's the buyers and sellers that set the price. And because of the auction-driven nature of the market, so if we have a private company, he has a gas station, they want to sell the other station, they want to sell their petrol station, you're generally going to have intelligent buyers facing an intelligent seller, and you'll come up with some price that will be close to the actual value of the gas station. But when you have auction-driven market, you have a lot of undershooting and overshooting that happens all the time. In 2022, we saw a lot of overshooting, right? A lot of high flyers, a lot of great businesses got really, a year ago, for whatever reason, these auction participants gave Facebook/Meta Labs a certain valuation. And then by the end of the year, they had taken it out back and shot it. The same business, not much has changed. But in the course of a year, there was a dramatic change in valuation. And if Meta had been a private company and they tried to sell themselves a year ago, and they were trying to sell themselves today, the delta may not be anywhere near the way it is in the equity market. So when we see the undershooting of securities, that gives us some possibilities. And then you might say that this is so hard, 50,000 stocks. And if you ask Warren that, he would say, start with the A's. And Buffett actually went through in the 1950s, he went through something known as the Moody's Manual, which listed all these companies. There are 4 companies on a page, very thin pages, big, thick books. And I bought a couple of Moody's Manual on eBay a few years back just for nostalgia's sake. And but he would go through each company, and there were thousands of companies, and they just had basic balance sheet and income statement data. And he ran some classes with MBA students a few years back. And he would find a company where the earnings were $15 million a year and the market cap was 25 million, things like that. Just things that made no sense. And when he found these things that made no sense, then he would dig into those. And he did really well. To take a step back, going back to horse racing, you know who we are as humans at the age of 5 and who we are at the age of 95. There is no change. Basically, our personality template, our traits, our likes and dislikes, who we are, is pretty much hard-coded at the age of 5. And between your genetics and your experiences in the first 5 years of life, that die is cast. And after that, there's not going to be any change. Buffett, when he was a young teenager in Omaha, he used to go to the local racetrack, Ak-Sar-Ben, which is Nebraska spelled backwards. And what he'd do is after all the races had been run, he'd collect all the tickets that people had discarded and thrown on the ground. And he'd collect them all, he'd bring them home, and he'd go through each one carefully to see if some drunk guy had thrown away a winning ticket. And lo and behold, he would actually find a few tickets which actually were winners, but people had thrown them away. And then because he was underage, he couldn't go to the window to cash it. So he would send his Aunt Alice with these tickets to cash them in. And so the kid who was doing that at the age of 12 was the same kid who at the age of 26 or something was thumbing through the Moody's manual in 1956 or 57. And one time my friend Guy Spear and I visited his office in Omaha. I think this must have been like 2010 or 2011. We used to go have lunch once a year with Buffett's assistant, Debbie Bozanic. And we paid a good amount of money to have lunch with Buffett. But quite frankly, the lunches with Debbie were a lot more fun. And I learned a lot from Debbie. And one year, I think 2010 or 2011 or thereabouts, we had gone to have lunch with Debbie. And when I went to the 14th floor of Kiewit Plaza with Guy Spear, Warren was standing right at the elevator, like to receive us. We didn't have an appointment with him or anything. And he says to us, would you like a tour of headquarters? I said, Warren, if you want to hang out with a couple of yo-yos, it's perfectly fine with us. We've got nothing to do twiddling your thumbs. And so he gave us a great tour of the headquarters, showing us all the mementos and different things. And then he took us to his office, his private office. And there I saw on his desk the Japan Company Handbook, which is basically just like the Moody's manual. It's like value line for Japan. And they have 2 companies on one page, lists every Japanese company. And he was thumbing to it. Now Berkshire's managing tens or hundreds of billions at that point. And you can't be playing these Mickey Mouse games with the Xarban tickets and stuff. So I had actually been going through the Moody's manual, just coincidentally, the Japan Company Handbook, just coincidentally, before I actually went to the office. So I took his copy of the Japan Company Handbook and I said, Warren, I'm going to like dog ear some pages that I found interesting that you might find interesting. Now, I don't know whether he was horrified that I was taking his Japan Company Handbook and mutilating it, but I just went ahead and did that. And a lot of the companies that I thought were these super cheap companies statistically were towards the back of the book. He says, yeah, what I found is the good stuff is always at the back. And so the kid at 12, the kid at 26, the kid at 81 or 82, it was the same kid. No change at all, and the kid today is the same too. So Munger would say, when you say, oh, this is so much work and this and that, Munger's answer would be, why should it be easy to get rich? Why should it be so easy for you to find the 3-cent dollar bill? But what I'm here to tell you is the 3-cent or 2-cent or 1-cent dollar bill is sitting there. It's there today, it's there tomorrow, it's there 5 years from now. The only question is, how determined are you to find it? And how many pages are you willing to flip? How many rocks are you willing to turn over? And like this company in Turkey, it's like one and done. I don't think God loves me so much that I'm going to find another one. But I still keep looking. I'm still hunting. One and done is perfectly fine with me. It's better than 0 and done. So all of you are really young. You're really smart. You have a lot of tools and resources to look up all of these companies. Start with the A's, or maybe it might be better to start with the Z's because the stuff is the good stuff in the back. And all the best. The second approach is where you identify a great compounder that, because of people not willing to look at the right time horizons and you can look around the corner, you could pay what would be either a reasonable or even an expensive looking price and end up with a great result. So if we have a crystal ball that can tell us what a company might look like 50 years from now, 30 years from now, then, we could buy something at $1 billion market cap and it might become 200 billion. And for me personally, that is a lot harder game to learn and play. I would like to do that. But so I'm open to both games. I think for me personally, the first game might be a tad easier. And because we have these auction-driven markets and because people vacillate between fear and greed, we can get there.
Excellent. Thank you so much for your answer, Mohnish. Well, we've reached 40 now, so we'd like to open up to the audience for questions. Of course, we've got a lot of questions still here, so we're happy to continue, but we'd like to.
Hi, my name is Remy. I'm studying politics and economics here. So you mentioned that in recent times, you no longer look at companies in the US, you look at companies in India when you're looking for companies to invest with data. We're looking for companies that you feel have a value, an intrinsic value that is higher than what they're valued on the market. And I wanted to know if you had any advice on navigating certain trade-offs associated with investing in emerging markets.
Yeah, so I think the most important, there are 2 or 3 important things, but I would say probably amongst the most important filter is circle of competence. So when we look at a business, we really have to understand it cold. And if we aren't, and most humans have a limited circle of competence. So there's no problem with having a small circle of competence. In fact, you can get extremely wealthy with an extremely narrow circle of competence. That is the nature of most entrepreneurs. Their circle of competence is very narrow. They are, in many cases, an inch wide and a mile deep. And it works well for them. So we have to be honest with ourselves and we have to ask ourselves, is this business within our circle of competence? And it might be the case in 98 or 99% of businesses you encounter. The answer is no. If I encounter any biotech company, I know nothing about it. I can't do anything with it. I don't like the healthcare space. I just say, I'll take a pass on that. There's entire large like defense companies or defense contractors. I just don't like businesses that have one customer, which is the government, because I think that it gets a little shady sometimes and there could be non-market forces. I just don't like those businesses. Now, they could be really good investments for someone else, but they're not for me. So lots and lot of things I will quickly get rid of, or irrationally. And it doesn't matter if you get rid of a business that eventually goes up 100 times or 1,000 times. What matters more is to avoid the ones that you don't really understand. And so the first is circle of competence. The second is margin of safety. So if you have a good understanding of a company, by definition, you know what it's worth. You can't really have a good understanding and then basically say, I don't know what this is worth. And if you know what it's worth, and you obviously the market's giving you a market price, if you see a large enough delta there. So the third thing is be very unreasonable. So if you say to yourself, I want to buy things that are 50% off, you will find plenty of companies. If you become more unreasonable and I say, I want to buy something that's 75% off, you will still find companies. If you say to yourself, I want things that are 90% off, you'll still find companies. Because the universe of companies is so large, if you are willing to dig through those 50,000 businesses, you'll find them at 50, 70, 90, 95% off. And they're not that common. And obviously you have to overlay that with circle of competence, but they're there. And so this is the way it is. It's a treasure hunt. You're looking for a needle in the haystack, and you want 7 moons to line up. And the other side of this is if you made 8 or 10 bets like this, and even half of them didn't work, which is probably going to be the case, error rate here might be 50%. It doesn't matter. And if you're right on 4 out of 8 or 5 out of 10 or 6 out of 10, it's going to work out spectacularly for you. And so it's a pretty straightforward, I would say, template and game plan. Execution is not so straightforward, but if you're dogged and focused, you can get there.
Mohnish, a question from online from David. Would you say a better use of your time to spend time looking at industry leaders or investors for young people learning how to invest their own money?
I think it is unlikely that a large business that's followed by 20 analysts is widely mispriced or widely underpriced. It could happen, but it's unlikely. I think you could have paid any multiple for Microsoft when it went public in the 80s, almost any multiple for Walmart when it went public in the 70s, and you would have still done extremely well. And so there are some truly great businesses with very long-term moats that just held them for long enough, you would do really well. But I think the better framework is to take the path less traveled. Like when Charlie bought Belridge Oil, it was a very obscure company. When I bought Reysas logistics. I couldn't convince even my best friends who are really good investors to even spend 5 minutes to look at the business. They just said Turkey, some nano cap. I'm not interested. And I couldn't even get to the next sentence with them. And so I think you're better off being an independent thinker, and you're better off going through some of these obscure names, looking for that needle in the haystack.
Excellent. Thank you, Mohnish. Just getting a question from online as well.
Yeah, hi Mohnish. I'm Jonas. I'm the president of the Hedge Fund Society, and on behalf of our society, I also really wanted to thank you for taking the time. I've been following you for a few years, and it's a great pleasure to have you over as a speaker. I'm unfortunately not in London right now, so tuning in from online. But I have a question about your process. So while I was following you, sometimes I just wonder, because you usually talk about more qualitative factors. So I just wonder what your investment process is like. Do you actually have a sophisticated financial model like some of us would learn when they start working at an investment bank, or do you rather look at something more simplified like multiples, or is it more of a qualitative analysis and you want the valuation to be so obviously cheap that you don't have to really dive deep into the valuation? So a bit color on that would be super interesting.
Yeah, so one of the issues we face is that the data set is too large. So when you have 50,000 stocks in the world, and if you were to spend a month on each one, unfortunately, God hasn't given us 50,000 months on planet Earth to go through them all. We've got probably less than 10,000 or 12,000. We got less than probably 10,000 months total, and or less than 1,000, I would say. So it's 120 months is 10 years. So yeah, we only have about 1,500 months before we're dead and gone. And if you spent your whole life looking at every business, and you started when you were 20 and you went till you were 80, you could look at 66 or 7,000 businesses or something. It's not much that you would actually be able to get through. Actually, not even 6 or 7,000. You would get through about 100 businesses every 10 years, and you would probably get to 600 or 700 businesses in a lifetime. And that's just doing nothing else. And which means that you would basically have only looked at something like 1% of the full data set. So we need hacks. We can't do it just. And so there are several hacks you can use. One hack you can use is you could go and look at something like Value Investors Club, which has a rigorous membership requirement, and the quality of the ideas posted is well above average. And so if you limited yourself to only companies that have a write-up on Value Investors Club, that's a much more manageable data set. And you could actually drill down on a lot more businesses. If you went down that route, you might be able to maybe look at a few hundred businesses a year. And the good thing with the Value Investors Club is that you get digested data. So you get both qualitative and quantitative data in a pretty digested form, where someone has spent the time to write it up and is giving you the story and all that. Now, you may agree or disagree or not understand the story, and that's fine. You can let things go if they don't make sense. So that's one hack. Dataroma is another hack, which is a site that lists the major holdings of a bunch of great investors. So if it's already gone through one filter, someone smart that you admire already bought it, that's a great list to go window shopping and then hopefully actually shopping in. So you can do some hacks like that. What does Berkshire's portfolio look like, for example? And take it from there. So these are some of the things you can do where you can winnow down that 50,000 stock universe, which is impossible to go through, into something more manageable. And then on the other end of the spectrum, other side, if you end up with one or two ideas that you can find in a year that go through all these filters, that's a really good outcome. So if you're able to find one good investment a year, I think that's a year well spent. And so that's how I would, and that's how I do go about it, is I am a shameless cloner. And I want to leverage what other people have already figured out. Value Investors Club is good, Dataroma is good, and anything I can find out where someone else has already done some work and has some perspective, I would like to understand the perspective and then take it from there.
Great, thank you. Just a very quick follow-up in terms of you actually evaluating it yourself. Do you actually build a financial model, or how do you assess it? Or do you think that's a waste of time and false wish of accuracy.
I gave a talk some years back, 10 Commandments of Investment Management. And the commandment that came down the mountain, there were actually two sets of 10. One was for investment managers and one was for humanity. The investment manager tablet dropped and broke, and we never got that. So I had to create it for us investment managers. And one of the commandments is, thou shalt never use Excel. And so if you find yourself reaching for Excel, then you know you don't have Belridge Oil and you don't have Reysas. So if it doesn't hit you over the head, like this is a total no-brainer. So I think it's a good idea to look at things and read things where things are so blindingly obvious just on the first read. Now, you may need to do more work to fine-tune it, but it should just hit you so obviously that this is worth 10 times what I'm going to be paying for it. And that's the way to go. And Excel is not the way to get there.
All right, thank you.
Hi, Mohnish, I'm Cedric here, and thank you for sharing with us. And you just mentioned that we should probably not use the Excel when it comes to value a business. I just wonder, for example, Charlie has mentioned lots of mental models, for example, the cognitive misjudgment and also the probability. I just wonder if there is any mental models that you think is very useful to recommend it for us to study.
Yeah, so first of all, on Excel, I know that me and your finance professors at LSE are completely in sync. They would never ask you to use Excel for anything, and neither would I. So that's wonderful. So we can just toss Excel out the window because no self-respecting business school professor would ever ask for that. So having said that, what I would say with the mental models is the following. I sometimes have to pinch myself, but I've had a chance to have dinner with Charlie many times in his home, and I've played bridge with him for many hours. And I think what I learned the most from all of that was just observing him, not so much what he was saying, but just watching how he functions. I think watching him gave me more insights than anything what he was actually saying. And what I realized about Charlie is that he has a very large brain. He's got very high horsepower. And what he's also doing with that very large brain is he is pounding a massive amount of information into that brain. So I think Charlie must read 400 or 500 books a year. And when he's sitting in his kind of easy chair at home, there's a pile of books on one side and another pile of books on the other side. And it's like an assembly line. These books are just pounding through, probably more than one or two a day. But neither the large brain nor that huge amount of data going into his brain is responsible for his success, in my opinion. What I believe is truly responsible for his success is the mental model hacks. So what Charlie has been able to do over the last 50, 70, 80 years is that he's been able to figure out certain mental models. And when he figures out certain mental models, he gets those etched in his brain. And when you start putting something like 30, 40, 50 mental models in your brain, and when you encounter some company or business that you're looking at, and instantly 3 or 4 mental models come and work on that particular business, you are able to get to a perspective on that company relatively quickly and probably relatively very accurately that most of the humans are going to have a hard time with. So the key to actually getting great at some of these things is to get a lot of fluency. First of all, you have to get the mental models into your system. The second is you have to believe in those models. And the third is you've got to be able to very quickly overlay 3, 4, 5 of these models that apply in a particular situation. And especially when what Charlie says is that when multiple mental models are working in the same direction, that's when you get Lollapalooza effects. So for example, if you look on YouTube, there's a talk I gave many years ago on Coca-Cola. And I went through a bunch of the mental models that Warren and Charlie used when they were figuring Coke out. And there's a whole bunch of different ones that go in. And once they saw that there were like 4 or 5 models working in the same direction, they knew they had a winner because of the way that would work. There are many different mental models. Cloning is a mental model. The reciprocity of humans is a mental model. There's many mental models. So if you go to Poor Charlie's Almanac, which is my favorite book, there's the last chapter in the book is the psychology of human misjudgment, which is a talk Charlie gave a long time ago at Harvard. And I think it probably took him something like 40 or 50 years to prepare for that talk. I don't think he could have given that talk 30 years ago, 40 years ago, because he didn't have the model. So that talk lays out something like 30 models, 20 or 30 models that I try to reread that talk every year. And every year when I reread it, I think I pick up new stuff. And I'm not that good at being able to overlay these models and recall them that quickly like he does. He's got a fluency of recall and a fluency of understanding which ones apply. So when you look at a situation and you just look at a lot of data you have in your head against that situation, that's a very blunt tool. But if you look at a situation and you're able to recall 4 mental models, like one of the mental models for Coke is something we in humans have known as association tendency. So Coke likes to advertise wherever people are happy. So they are at the Olympic Games and they try to be at the Super Bowl and they want to be with you at movie theaters and all of this, right? Because they feel that if you're in a happy place and you consume Coke, then it's kind of Pavlov's dog conditioning. You're going to actually think that it's a Coke that made you happy, right? And so the association tendency is something that advertisers understand really well. And it's one mental model that Coke uses. And if you start overlaying these other mental models with that, then you start getting these kind of unusual effects. That's the same reason why Coke uses celebrities, right? So if we have some George Clooney type character drinking Coke, we're going to think, oh, we'll be like Clooney too if we drink the Coke. And so the association tendency kicks in there as well. So I think that building an arsenal of mental models, and one doesn't even need to be that, I don't think I'm that good at it. I've just got a few models that I think a lot of humans ignore, that I don't think one should ignore, that can give you a good edge. I think cloning has given me a huge edge in getting a head start in life. I think that I understood how Warren and Charlie went on these treasure hunts, and it fits in my psyche to go on treasure hunts. So for some people, it may not fit with their psyche, but for some people it will. And so the combination of a treasure hunt with being able to take something that shows up and then overlay a bunch of other models on it. So for example, this company in Reysas in Turkey was really cheap. But the thing that was more interesting to me about that company was not that it was a 3-cent dollar bill. What was more interesting to me about it was that they're not interested in investing capital if the rate of return is below 25 to 35%. So it's the reinvestment rate that's more interesting. So the 3-cent dollar bill, I'll get a 30x. But if the dollar bill becomes a $20 bill, that's far more interesting. And now 3 cents can become $20. And that's much more interesting than 3 cents becoming $1. So the mental model of compounding is well understood by many of us. So when you overlay cheapness with goodness, which is what you get with high return on equity businesses, good businesses generating high returns, we know that high returns over a long period with long runways get you remarkable results. But when you overlay that with something that's really cheap, you're going to get what Munger would call Lollapalooza effects. Because if I bought the same thing at 100 cents on the dollar and it compounds, I still do well. But if I buy it at 5 cents or 3 cents and then it compounds, that's just off the charts. And so I would say focus on the hacks, focus on the mental models, and build And Munger can give you a big head start because it takes a while to build these and learn these and internalize these.
Thank you so much for sharing.
Okay. I think are we out of time?
Yeah, Mohnish, I was actually just going to ask if we could ask one more question that relates a little bit to what you were just saying with regards to Munger and which others on, and that's okay.
Yeah, that'd be great. Sure.
Excellent, excellent. First of all, as Mohnish mentioned, brilliant book. Please, all of you read it. I'm just reading it now. Excellent, excellent book. But in one of the things that one of Charlie's interviews in it, Munger mentions that one of the reasons that Buffett continues to build Berkshire, and I'm sure you're aware of this as well, is to have a platform, to essentially have people listen to his very good notions, his lessons that he has to share. And obviously you've benefited hugely from it. We've benefited hugely from it, probably a big reason why all of us are here today. And now we're also here benefiting from your platform. Just like to ask you, what's your motivation to build a platform that you have? And is it for similar reasons?
I think the value investing community, going back to Ben Graham, has a ethos of knowledge sharing and teaching. And it goes back to Graham. Graham did a great job of that very selflessly. And then Buffett and Munger did a great job with that very selflessly. So I think it's just part of the community. I think there are a lot of practitioners in the community who follow that ethos and not going to become any poorer by sharing any of these things. And actually, I have no original ideas. Whatever I'm sharing from you is coming from other masters. And so it's not I figured something out. I haven't figured anything out. I'm just a shameless cloner. So it's just, I would say that I have been deeply enriched by the teachers that came before me who were such great teachers. And to the extent that I can be helpful, I'm more than happy to be helpful.
Thank you very much.
You think one thing interesting, Buffett says that what he wants on his gravestone, he says just he was a teacher. I think that's what he wants to be most remembered as, that he was a teacher.
Well, Mohnish, thank you so much for your time. There's no better way to end it other than that. Yeah, can we just give Mohnish a quick...
It was a pleasure. Thank you very much. I really enjoyed the session. And I'm sorry my answers are long-winded, so we probably didn't get to a lot of your questions, but hopefully we can do that. We can do another session maybe next year and see if we can make some progress.
Absolutely. We'll save it for the next one. Mohnish, thank you so much for your time.
All right. Bye.